Welcome back to the deep dive. We're picking up where we left off, exploring the more specialized areas of accounting.
Right.
Still using Christine Johnnick's Principles of Financial Accounting as our guide.
Yeah, and she does such a good job with this stuff.
Yeah.
Like, she makes these really complicated topics surprisingly approachable,
Yeah.
even for people who don't have, like, a background in accounting.
Yeah, totally. Okay, let's start with payroll.
Okay.
It seems pretty straightforward.
Yeah.
Employees work, they get paid.
Right.
What are the accounting considerations that we need to be aware of?
Well, it's more than just, like, calculating hours and multiplying by an hourly rate.
Okay.
First, we have to differentiate between salary and wages.
Oh.
A salary is a fixed annual amount,
Okay.
and wages are based on an hourly rate.
Gotcha. So a salary is like a fixed income,
Right.
and wages can fluctuate
Yeah.
depending on how many hours you work.
Exactly.
Okay, and then there's gross pay, which is the total amount earned before
Yeah.
any deductions.
Yeah, and that's where it gets a little more complicated. Employers are required to withhold certain taxes from employees' gross pay, like federal and state income taxes, Social Security tax, Medicare tax.
So it's like every business is running their own
Yeah.
mini tax collection agency?
In a way, yeah, and there's more.
Well,
The employer also has to pay their own share of those payroll taxes.
oh, wow.
So they match the employee's Social Security and Medicare contributions.
Okay.
Plus, they pay federal and state unemployment insurance taxes.
So there's a significant cost to employers beyond just
Yeah,
the gross pay.
absolutely.
Wow. Okay, so it's important for both employers and employees to really
Yeah,
understand those payroll nuances.
absolutely.
Okay, let's move on to bonds.
Right.
I feel like they can be a little intimidating.
Yeah, they can be.
But I think Jonik does a pretty good job of breaking them down.
She does. She does.
What are bonds and how do they work from like an accounting perspective?
Okay, so basically, bonds are a way for companies to borrow money. But instead of going to a bank, they borrow from investors.
Okay.
And so they issue these bonds, usually in increments of like $1,000,
Okay.
and investors buy them, essentially lending the company money.
So it's like crowdfunding a loan.
Yeah, you could think of it that way.
Okay.
And then in exchange for that loan, the company promises to pay back the face value of the bond
Okay.
at a specific date, which is called the maturity date.
Right.
And they also make these periodic interest payments.
Okay, so it's like a fancy IOU
Yeah, pretty much.
with interest.
Yeah.
Okay, so what determines the interest rate on a bond?
So that's where the market rate comes in.
Okay.
That's basically the prevailing interest rate that investors expect to earn on similar investments.
Okay.
So if a company wants to issue a bond,
Yeah.
they have to offer an interest rate that's at least competitive with the market rate.
Makes sense. So like if interest rates in general go up,
Right.
the company would have to offer a higher interest rate on its bonds to attract investors.
Exactly. Yeah.
Okay, now this is where it gets interesting from an accounting perspective.
Right.
If the interest rate that's offered by the bond is higher than the market rate,
Okay.
then the bond is going to sell at a premium,
Yeah.
meaning investors are willing to pay more than the face value
Right.
because they're getting a better return.
Exactly. They're getting a better return than they could get somewhere else.
Right, but if the bond's interest rate is lower than the market rate,
Okay.
then it's going to sell at a discount,
Mm.
meaning investors are going to pay less than the face value.
Right, because they're accepting a lower return.
Right, okay.
So basically, the price of the bond can fluctuate based on how its interest rate compares to the market rate.
Right, and how does that affect the accounting?
So the difference between the face value and the selling price,
Okay.
whether it's a premium or a discount,
Yeah.
needs to be accounted for over the life of the bond.
Okay.
And that's where amortization comes in.
Amortization. Remind me what that is again.
Yeah, it's like depreciation, but for intangible assets.
Right.
So we're gradually reducing the value of that premium or discount over time.
Okay.
So by the time the bond matures, its carrying value
Right.
equals its face value.
So we're spreading out that extra cost of the premium
Yeah.
or the savings from the discount
Right.
over the life of the bond.
Exactly.
Okay, now Jonik also mentions callable bonds.
Right.
What are those?
So those are bonds that give the company the option to redeem them
Okay.
before the maturity date.
Why would they do that?
Well, it can be advantageous if interest rates have fallen since the bond was issued,
Right.
because they can basically refinance the debt at a lower rate.
Oh, okay. So it's like refinancing your mortgage
Yeah, exactly.
when interest rates drop.
Right.
Smart move. Okay, so what happens if they call the bond
Okay.
and have to pay the investors like more than the carrying value?
That would result in a loss on redemption,
Okay.
but if they pay less, it's a gain.
Interesting. So it seems like there's a real strategic element to
Yeah.
managing bonds.
There is. There is.
Okay, let's move on to stockholders' equity.
All right.
Remind me again what that represents.
So stockholders' equity is basically the owner's stake in the company.
Okay.
So you take the assets, subtract the liabilities,
Yeah.
and whatever is left over is the stockholders' equity.
Right. So it's like the net worth of the business
Exactly.
from the owner's perspective.
Yeah.
Okay. What are the key things we need to understand about stockholders' equity?
So first, we need to look at the different types of stock.
Okay.
The most common types are common stock and preferred stock.
Gotcha.
So common stock usually comes with voting rights, which lets the stockholders
Right.
have a say in company decisions.
Yeah.
Preferred stock usually doesn't have voting rights,
Oh.
but it often comes with a guaranteed dividend payment.
So it's a trade-off.
Yeah.
More control with common stock,
Right.
but potentially a more stable income with the preferred stock.
Exactly.
Okay, so when a company issues stock,
Right.
there's some key terms that we need to understand.
Uh,
First one, shares authorized. What is that?
So shares authorized is the maximum number of shares that the company is allowed to issue,
Okay.
and that's based on its corporate charter.
Gotcha. So it's like setting a limit on how many slices of pie you can cut.
You got it.
But they don't have to issue all those shares at once, right?
No, shares issued are the number of shares that have actually been sold
Oh.
to investors.
Makes sense. And that can never exceed the number of shares authorized.
It cannot.
Okay, what about par value?
So par value is this nominal amount that's assigned to each share of stock
Right.
when it's authorized.
Okay.
And it's mostly just an accounting thing. It doesn't usually reflect the actual
Right.
market value.
Okay, so it's like the minimum price tag,
Yeah,
but the real price is determined by the market.
exactly.
Okay, now what happens if a company sells a stock for more than its par value?
So that difference is recorded as additional paid-in capital. And that's essentially the extra money that investors are willing to pay
Gotcha.
above and beyond that par value.
Okay, so that's a good sign for the company.
Yeah.
That means investors are confident.
Yeah, they're willing to pay a premium.
Now, sometimes companies will buy back their own stock,
Right.
and this is called treasury stock.
Yeah.
Why would they do that?
There are a couple of reasons.
Okay.
They might do it to increase the value of the remaining shares.
Okay.
They might do it to prevent a hostile takeover.
Right.
Or maybe they want to use those shares for employee stock option plans.
So it's like strategically managing the number of slices of
Yeah.
pie that are out there.
Exactly.
What happens to those treasury shares?
So they can either hold on to them indefinitely,
Okay.
or they can reissue them at a later date.
Gotcha.
And if they sell them at a higher price than they paid,
Yeah.
they can actually make a profit.
Okay, that makes sense. Now, what about dividends?
All right.
How do those work from an accounting perspective?
So dividends are payments that are made to stockholders,
Okay.
usually out of the company's profits. Remember
Mhm.
those preferred stockholders?
Yeah.
They usually have a right to receive a fixed dividend payment. But for common stockholders,
Yeah.
it's not guaranteed.
Okay.
The company's board of directors decides whether to pay dividends to those common stockholders.
So it's like a bonus
Yeah.
if the company's doing well?
Exactly.
Okay, so there are some important dates associated with dividends
Yeah.
that we need to know about.
Right. The date of declaration is when the board of directors announces the dividend.
So it's like marking it on the calendar.
Right. Then
Yeah.
you have the date of record.
Okay.
That's the cutoff date for figuring out which stockholders are eligible to receive the dividend.
Gotcha. So if you own the stock on that date,
You get the dividend,
you get paid.
and then the date of payment is when the dividend is actually paid out.
Okay, so those dates are important for keeping track of
Yeah.
who gets paid. Now, there are different types of dividends.
Right.
Cash dividends and stock dividends. What's the difference?
Cash dividends are paid in cash.
Okay.
Stock dividends are paid in additional shares of stock.
Oh, interesting. So like giving out more pieces of the pie
Yeah.
instead of cash. Why would a company choose to do that?
It can be a way to conserve cash
Okay.
while still rewarding the stockholders.
What?
And it can also make the stock more attractive to some investors.
Yeah.
Because the price per share goes down after the stock dividend.
Right. Makes sense. What about stock splits?
Okay.
Are those similar to stock dividends?
They're similar in that they both increase the number of shares outstanding,
Okay.
but a stock split also decreases the par value
Right.
proportionally.
So if a company does like a 2-for-1 stock split,
Right.
Each shareholder would have twice as many shares,
Right.
but the price per share would be cut in half?
Exactly. So the total value of the company's stock should stay the same. But the lower price can make it more appealing to a wider range of investors.
It's like making the pie more accessible
Yeah.
by cutting it into smaller pieces.
Exactly.
This is all starting to make a lot more sense.
Good.
I can really see how accounting plays a role in all these different
Yeah.
aspects
Yeah.
of corporate finance.
It does.
Okay, we've covered a lot of ground in this part of our deep dive.
We have.
Payroll, bonds, stockholders' equity.
It's a lot.
It's amazing how accounting touches so many parts of business.
It really is the language of business.
And in the final part of our deep dive, we're going to be putting all of these concepts together
We are.
and learning how to analyze financial statements to uncover the story.
Yeah, the story behind the numbers.
Stay tuned.
Stay tuned.